Blockchain Vane builds a macro narrative around gold, Bitcoin, and liquidity, arguing that what traders call a gold-Bitcoin rotation is really the surface effect of deeper cycles in risk appetite and global money, not hordes of investors literally dumping gold bars to buy BTC. The story threads together safe haven psychology, central bank behavior, speculative manias, and the 2026 debt wall into one repeating pattern that explains why gold and crypto sometimes move opposite, sometimes together, and why the next big move in both may be down before the wheel turns again. Bitcoin, digital silver across from gold blockchain. Vane starts by acknowledging the meme that Bitcoin lags gold by 3 months, which, if taken literally, suggests a neat rotation from physical gold into digital gold. On paper, BTC does look gold-like. Fixed supply, self-custody, no single controller, and censorship-resistant settlement. But in actual portfolios, BTC is treated as a risk asset, more like a high-beta tech stock than a conservative store of value, even by many who call it digital gold. So in practice, it functions more like digital silver, a leveraged bet on the same macro forces that move gold. From that vantage point, the spectrum clarifies. On one end sits gold, the classic safe haven that has anchored wealth for millennia. On the other sits BTC, the volatile endpoint for risk-on capital looking for upside in a world of over-financialized tech and speculative flows. What looks like a simple 3-month lag between gold and Bitcoin is, in this framing, the delayed response of risk assets to shifts in the underlying risk-off versus risk-on regime, not a mechanical pipeline from one asset into the other. When gold and crypto swap roles, and when they don't, Blockchain Vane uses recent cycles to show how this regime shift plays out. In early 2020, as the pandemic broke out, gold rallied while BTC crashed. Textbook risk-off. Investors ran to safety, shed volatility, and BTC was collateral damage like equities. By summer 2020, unprecedented global stimulus flipped the environment to risk-on, gold rolled over, and crypto entered a monster run that carried altcoins into cycle tops in spring 2021, just as gold was bottoming. Capital moved out the risk spectrum as fear gave way to greed. But the relationship isn't as clean as gold up, crypto down. Blockchain Vane points to phases when they move together, both topping around early 2018 and late 2021, both bottoming around late 2018 and late 2022. The key to this flip is who is driving gold. When the marginal buyer is a cautious risk-off allocator, central banks, safety-seeking households, defensive institutional money, gold's rally coincides with pressure on crypto. When the marginal buyer is a risk-on speculator, chasing miners, silver and leveraged products, gold starts behaving like another high-beta play and can rally or crash in tandem with BTC. The 2024-2025 gold run, fundamentals first, then mania. To explain the current setup, Blockchain Vane dissects the gold rally since 2024 into 2 distinct legs. The first move, from roughly $2,200 at the start of 2024 to about $3,400 into mid-2025, is framed as fundamentals-driven. Central banks accumulating more gold after the freezing of Russian reserves signaled that Western government debt is no longer a politically neutral reserve asset, Chinese investors fleeing a CCP-induced housing bust, and Western investors wary of over-levered governments, bond risk, and frothy equity valuations. The second leg, blowing off from around 3,400 to a recent high near 4,600, is painted as speculation-driven. Search interest for gold and gold price goes vertical, gold miners and silver go parabolic, and yield-on-gold schemes start popping up in influencer feeds, a pattern very familiar from late-cycle crypto. Once yield is being marketed on top of a safe asset, it's a sign that leverage and speculative layering have taken over. At that point, gold is no longer just a hedge. It becomes another playground for the same risk-on capital that has historically fueled crypto bubbles. How speculative gold changes the correlation with Bitcoin. This shift in gold's demand drivers is the hinge of Blockchain Vane's argument about correlation. When risk-off players dominate gold, central banks, conservative savers, institutions fleeing bonds, its rallies tend to coincide with crypto drawdowns. Gold's rise is a symptom of fear, and volatile assets like BTC get repriced downward. But when risk-on players dominate, piling into gold miners, silver and gold yield products, gold behaves like a high-beta commodity, and its rallies and crashes become tied to the broader speculative cycle that also drives crypto. In that environment, the relationship can flip positive. If speculative capital is flooding both gold and altcoins, they can move up together. When leverage unwinds and liquidity tightens, they can dump together as forced selling hits everything that sat on the same pool of borrowed money. That's why Blockchain Vane argues the late 2025 configuration, parabolic gold alongside ripping silver and miners, is a warning. A future gold crash in this regime is likely bearish for crypto, not a bullish rotation into BTC. Liquidity cycles, debt walls, and why 2026 matters. To connect these asset-level stories, Blockchain Vane pulls in Michael Howell's global liquidity framework. Liquidity, broadly, the amount of usable money in the financial system, doesn't move randomly. It tends to follow a rhythm linked to a 4-5-year debt refinancing cycle, with a sizable debt wall expected in 2026. As big borrowers roll debt, they need cash, which they raise by selling assets, multiplied across governments, corporates, and wealthy individuals who keep most wealth in assets, stocks, crypto, metals. This selling mechanically drains liquidity. Historically, the most bullish phase for risk-on assets is the rising phase of the liquidity cycle, when central banks and credit markets are expanding balance sheets and money is cheap. The peak of liquidity, by contrast, tends to coincide with commodity tops, including precious metals and industrial commodities like copper and coffee, both of which have recently rallied, fitting Howell's view that we're at or near a liquidity crest into late 2025 and early 2026. What follows that peak is a liquidity contraction. As the 2026 debt wall approaches, demand for cash rises, the dollar index, DXY, tends to strengthen, and everything priced off abundant liquidity, equities, crypto, commodities, faces coordinated pressure. Blockchain Vane underscores that in such a scramble for cash, gold does not fall because crypto is stealing its bid, nor do BTC and altcoins rally because rotation is freeing up capital. They fall together because the entire risk structure is being repriced under a shrinking money pool. Why gold's next big drop could drag Bitcoin down. In this framework, the DXY becomes a simple real-time signal. A rising DXY means global demand for dollars is climbing, which usually happens when liquidity tightens and debt needs to be serviced. Under those conditions, gold, heavily owned by speculative, leveraged players late in the cycle, is vulnerable to a sharp sell-off. Blockchain Vane expects that once DXY turns up decisively in 2026, gold's speculative layer will be forced to unwind, yields will dry up, leverage longs will face margin calls, and prices will be kicked lower by liquidations. Crucially, crypto sits on that same speculative layer. The same funds, traders and structures that borrowed to lever into miners and silver have also levered into BTC and altcoins, and they will need to raise cash as liquidity is drained. That's why Blockchain Vane pushes back against the lazy thesis that gold crashed at BTC moon. Under current conditions, where gold's marginal flows are risk-on, a gold crash is a symptom of system-wide deleveraging that can smash crypto at the same time. The 2025 crypto liquidity disconnect and short-term hope. Blockchain Vane then addresses an uncomfortable fact. By mid to late 2025, global liquidity kept grinding higher, but crypto failed to respond, chopping sideways while US stocks, foreign equities, precious metals, and other commodities printed new highs. Given the usual 3-month lag between liquidity and crypto prices, something in the crypto plumbing appears to have broken. The channel's best guess is that the break started in spring 2025, when markets crashed around Trump's Liberation Day tariffs, and was brutally exposed by the October 10th liquidations. Those liquidations hit so hard precisely because crypto liquidity was already abnormal. Order books thin, leverage piled above real spot demand, so a shock that might have been absorbed in a healthier market instead triggered outsized cascades. Even so, Blockchain Vane sees room for a short-term reprieve. the Fed's December 2025 bond purchases, not QE in name but still a liquidity injection, and the drawdown of the US Treasury General account since November, both add incremental liquidity. Given crypto's usual 3-month lag, this could translate into a Q1 2026 bounce, especially if political catalysts like the Clarity Act, following 2025's Genius Act, refocus attention and capital on the sector. The likely path: pain, then reset, then a new cycle. Beyond that initial bounce, the outlook turns harsher again. As the 2026 debt wall arrives and the DXY rises, Blockchain Vein expects a broad liquidity contraction to weigh on all risk assets, including BTC and altcoins, regardless of what gold is doing day to day. In that phase, cash is king. Both gold and crypto are pressured, even if gold falls less in percentage terms as genuinely risk-off investors rebalance toward it while other assets are liquidated. The golden lining, as the video puts it, is structural. Every liquidity contraction induced by refinancing stress eventually forces policy panic. Once markets or the economy weaken enough, authorities reach for emergency tools, QE-style bond buying, credit programs, and other injections of money to stabilize the system. Those interventions have historically coincided with market bottoms, not tops, because policymakers only move aggressively when things already look bad. In Blockchain Vein's telling, that is when to expect the next true crypto cycle to ignite, about 3 months after emergency stimulus begins, as new liquidity filters through and risk appetite returns. At that point, gold likely bottoms alongside BTC, just as in 2018 and 2022, and the wheel turns again. Liquidity expands, stocks and crypto lead, and commodities, including gold, ultimately mark the next peak before the process repeats. Blockchain Vein builds a macro narrative around gold, Bitcoin, and liquidity, arguing that what traders call a gold-Bitcoin rotation is really the surface effect of deeper cycles in risk appetite and global money, not hordes of investors literally dumping gold bars to buy BTC.